Good evening, everyone. Uh, Again, my name is Dan Toll. I'm a mentor with SCORE. We're also joined by Bob Fedor, who's also a longtime mentor with SCORE and is well versed in funding and many other areas as well. So I have to sprint a little bit to get this presentation in within an hour's time, and that's what I'm going to try to do. And then if I cover anything too quickly that you have any questions about, you can uh, feel free to raise them to us at the end. Um, just the first few slides are about SCORE here itself. If I can get, there we go. SCORE is basically a network, a nationwide network of volunteers that folks who are either retired or still working, who have been very successful in their careers and in their respective endeavors, which cover a wide array of industries and types of businesses. So there's someone for everyone when it comes to SCORE. And let's move to the next one here. Again, the mission is really flows from the SBA, the U.S. Small Business Administration, that funds SCORE on an annual basis. Our mission is the same as the SBA's, which is to foster vibrant small business communities through mentoring and teaching and sharing knowledge. And we serve all comers and welcome everyone to reach out to us. Informally, the chapters across the country compete to basically serve you as best as we all individually can, and there are metrics by which we are gauged. And now it's a couple of years ago, 2022, SCORE Cleveland was the national chapter of the year. So we take this very seriously, and we take serving your needs very, very seriously. There is a code of ethics that governs our interaction with you. Any information you share with us is confidential. And obviously, what this code of ethics does is to make sure that we are working purely in your interest. And that's not a difficult thing to do, but we do have a code of ethics that governs our conduct and interaction with you. We are free and happily so. So that we hope we can reach a broader audience by providing these services free of charge. If you are desirous of working with a SCORE mentor, you can go to the SCORE website. If you just Google SCORE or SCORE Cleveland, you'll be able to access, as this screen depicts, you'll be able to request a mentor, or you can view the mentors that work for a particular chapter, in our case, Cleveland. And if there's someone that you'd like to work with specifically, you can opt for that. Or you could submit the nature of your request. For example, I'm trying to find funding. I'm starting up a business. And then our client team will assign you to a mentor who is versed in the area that you are seeking information, and will assign a mentor accordingly. What we have gone through here, and if you have participated in any of the prior sessions of Simple Steps to Starting a Business, gone through now 4 sessions covering sort of the broad range of things that are involved in getting together a business and getting it started. And this one is the final, well, it's not kind of, it is the final one, which addresses if you need funding, once you've got your business plan together and have considered all the other aspects of getting a business started. This addresses the funding options area. Getting started here, what I'm going to cover tonight is basically in general terms, the different types of funding that exist. And broadly speaking, there's equity or there's debt, and each one has its own characteristics. Both are viable sources for any startup. They are often used in combination. So it will cover that and just give you an idea. And I think what you'll be surprised by, particularly on the debt side, is that there is a real range of funding options out there that go beyond just bank lending. they may or may not be equally desirable as more conventional types of financing. But when you're getting a business started, you're really looking at everything and anything that might be can be a facilitator to get you going out of the gate. I'm also, since we're primarily focused on bank financing and SBA-backed financing in particular, I just want to walk through in general just the loan approval process within an institution and how a loan is evaluated. And then I just close with a few recommended steps that are kind of independent of the funding arena. Before I get started, I just want to give a little bit on my background. I've been in commercial lending for about 30 years now. I've been in large corporate lending, so-called middle market lending, and also small business lending, and that's where I started. And the last 3+ years, I've been working for the SBA, and I work on one of their funding programs as a credit officer, reviewing applications for funding. The SBA has two broad types of programs. One is their 7A program. Another is called their 504. I work on the 504 program, and we'll get into what that means as far as what different types of businesses or types of funding are provided under these different programs. Equity funding. What is equity? Well, essentially, the easiest way to start to think about it is it's the amount of money that you contribute to your startup to get going. At least at the outset, that's what it represents. And thereafter, as you put in additional monies for further investments as your business starts to grow, and as your business is profitable, that accrues to your equity. And on the converse side of that, when you take money out of your business to pay yourself in the form of dividends, that reduces your equity. But the simplest way to think about it from a funding standpoint is this is the money that you put in that's going to stay there, that is not readily repaid in the way that debt is. These contributions, when you start your business up, it's not only the cash, but also the way you've used your cash to capitalize your business. So any equipment that you've purchased or any other inventory, supplies, all of these things are part of your capital base when you start and are considered equity. You can access third-party equity if you need it. For instance, if I need to start my business, the total cost to get my business started is $100,000, and I've only got 50. An option that I have is to reach out to a third party, be it someone in your professional network. Friends and family is very often tapped to get businesses started that will, can contribute the other $50,000 to help you get started. The flip side of that, though, is that you surrender part of your ownership. So say we use the $50,000 example. If we go strictly by cost, well, I would have 50% of the equity, and whoever I bring in to inject the other 50,000 would have the other 50% share. So it's not, I think most businesses in general most owners want to retain all of the equity if they can, all of the ownership. But again, it's a function of what is possible at the time that you want to get started. And if you need more money and you can get it through equity sources, then for a time that may be acceptable to you. There are lots of different types of sources here. So I think a lot of these you will recognize. I mean, obviously, savings that you've accrued over time. Many people borrow against a home equity line to contribute money towards their startup. Personal credit cards can be used. You can, if you have a benefit plan as part of the company that you work for, a retirement plan, a 401k or an IRA, but specifically 401k, you can borrow against the value of the assets in the 401k plan. CVLI stands for the cash value of life insurance. So if you have a life insurance policy that you are paying over time, as you continue to pay the premiums, there's a cash value that builds up in that policy, and you can borrow against that as well. There are other types of personal loans, other types of resources that you can try to tap into. Again, friends and family is a common one. For those of us who are lucky to have friends or family that would be willing and have the means to contribute, that's often a good way to get started. Or again, it can be members of your professional network. Crowdfunding is a type of funding that has taken root in really the last 15 years. It's got to the point where it is actually now regulated by the SEC, which is generally a good thing for both investors in your business and you as the owner of your business. So that essentially it makes sure that essentially all the information about your business, if you're going out to obtain funds by this means, are disclosed to your investors. And it also prescribes the rules that your investors have to abide by as equity investors in your company. But essentially, crowdfunding, I list several of these sites in the presentation. But what it involves is essentially taking your business plan and going onto this site where you can have what's called a campaign. Typically, they run 60 days, but you will put your business plan out there. It will get kind of squeegeed into the formal documents that are required by the SEC, the so-called offering documents of your equity raise. So say that I want to, let's go $100,000 again, and I need to raise 50 of that $100,000. One option is that I can go and provide my information about my startup, projected financials and everything, and I want to raise $50,000. So once I've got all my documents put together and I'm ready to go, the campaign starts. And if I get, essentially it runs for 60 days. And what happens is, and the reason it's called crowdfunding is that crowdfunding was established as a way to kind of democratize access to investment in private companies, such as your startup or mine, by folks like us. Not just the 1%, not just the wealthy, but folks that want to invest or are able to invest in smaller increments of funds. So if I'm raising $50,000, it depends by each particular offering, but I can invest in that company for only $1,000 or even $500 and have a share of this company, or my company in this instance. So it basically works. It's a benefit both ways. You get access to a much broader audience for potential investors, and potential investors that like what you are doing or starting up, they don't have to come up with a large amount of money to have an equity share in your business. So it works both ways. And there will be specific terms associated with the equity offering. And by the way, this also works on the debt side, as you will see, but the basic function is the same thing, where you're putting your information out there and trying to raise either equity or debt, which means people have equity ownership in it, or if it's debt, that they will receive repayments of debt over a 5 to 7 year period at a prescribed interest rate, and function just like any other debt would, where if someone is interested in, say interest rates on these run from probably on the higher end now, say 8 to 13%, starting to come back down if it's a debt offering. So the benefit that I would be getting as a $1,000 investor in that 50,000 offering is I get a 13% return on my money. So it's still maturing as a source. And what I mean by maturing initially was that when it started, it was well intentioned, but it was a little bit of the Wild West. And once people saw that you wanted to make sure that representations made by both parties were going to be lived up to, and that frankly there would be no scamming, no frauds, this kind of thing, like can happen on GoFundMe, for example, which is a crowdfunding site, but they have had issues with that. So that's why the Securities and Exchange Commission stepped in to regulate this, and now there are formal documents, formal representations that have legal teeth. So it's still growing. as a source, and I encourage you to go on to these various websites. WeFunder is one that I mentioned here. Honeycomb, we'll see on a couple of pages, is our next page, is another debt provider. I think I know they have debt raises, but it's something to investigate because it is a viable source. Another form of equity investor is angel investors. And now these are, if you were to Google angel network, Cleveland Angel Network, you would actually see something pop up that is basically has a list of individuals that are wealthy, typically, who are wealthy, I should say, that are interested in still investing in other ventures. And your venture might be one that they are interested in. Now, typically, these are more, and I'm going to get to venture capital in just a second, but they're a little more high tech or high growth types of expectations, unique offerings, maybe something that via research and development is kind of a new offering, new type of business, or a new take on a business, as opposed to what I would characterize as the Main Street type of businesses that we typically see both as lenders, commercial lenders, and also from you, folks that want to be a plumbing contractor or start a bakery or these kinds of things, which they aren't new creations in terms of the boundaries of business, but they're the types of meat and potato businesses that are central to every community and are needed. And there are a lot of people that want to provide those. But you'll get a list of investors. They may be interested in contributing, maybe that $50,000 that I referenced in the example. Maybe you can catch the attention of. It's a little less likely, but I'm mentioning them just in a broad scale, just so that you know the types that are out there. And then the last one is venture capital. And if you want to think about venture capital financing, you're talking about Amazon when it started, or maybe a little bit thereafter, had a little bit of teeth, where it's anticipates high growth. It is potentially breaking new barriers. So you see a lot of this with tech and science types of oriented business, where it's some kind of new drug breakthrough. Or with Amazon, it was really bringing e-commerce onto the stage in the way that it never had been before, and was really the example for all to follow thereafter. So venture capitalists provide like a series of, they will provide series of fundings as a venture grows. But again, these are oriented towards new products, new things on the scene that the venture capital investors anticipate will have high growth and will eventually allow them an exit with a lot of profit at the other end, with the company going public, which then allows the venture capitalist ownership stake to be liquidated, to become liquid, so that they can get their return in that way. But it's typically, again, just mentioning it because it is a type, but really we're talking about equity. We're talking about the first few kinds here, the first few types that I've mentioned. That's going to be more along the lines of what most of us would be trying to access. Debt sources. Want to make clear that we're going to look at a variety of sources. Some have what are on the surface and are in reality ridiculous costs associated with them. Interest rates from 25 to 50%. But I state here that no one source is better than another, because for maybe the nature of my startup is such that it's easier for a bank, say with a partial guarantee for the SBA, it's easier for them to consider it. But some businesses aren't bankable right out of the gate, because it can be because of a number of reasons. But essentially, if I'm trying to get my business started and I'm both, all 10 toes in, this is what I'm going to do. Well, for the first month or two or three, maybe that 25 to 50% interest rate is worth it if I can start getting customers and I can start building a track record that will then allow me to access down the line the lower cost funding that conventional banking arrangements provide. So we'll go through them quickly, but I am sort of agnostic. I'm not going to sit here and say that's bad and that's good. It really just depends on what your unique circumstances are. You will see that, and I just want to mention that one of the things that differentiates how expensive a particular type of debt financing is how much information that the particular source gathers about you. So let's use, for example, business credit cards. And for startups, they're going to be very expensive. They're hard to get, but it's possible to get business credit card. It's going to be very expensive. Why is that? Well, it's because they are gathering very little information about you on a relative basis. I mean, think about your personal credit cards. You get offers in the mail. I mean, you'll get credit cards chucked at you, offerings, just to take advantage of what they are offering. Because the only thing they're going to look at is your credit score and your income. They don't know the probability of you having that same income the next year. They don't know what it's been historically. They do a little bit from your credit score that you've at least, if it's a good score, that you've been able to handle most or all of your obligations in an acceptable way. But the information they gather is really, in the scheme of things, very little. On a business credit card, they may, and some of these other sources, they may just ask for what you're going to use the funds for, what your personal credit score is, and it's really use of funds, maybe the type of business, what your projected revenue is, and that's it. So that's not a lot of information. So the reason that they charge those high rates is because they're not getting much information about you. So they know they are open to the possibility, and in fact, it does occur, they have greater number of losses, okay? And again, if you think about just mailing credit card offers out to people, well, again, with just a couple of metrics and no other kinds of go-forward restrictions other than maybe a credit limit, they're not going to know how viable you are in terms of repaying that obligation. So they have more losses. So why do they compensate? Or why do they compensate at the level they do, that 25% or greater, is to compensate for those losses. So it's really information is the key. Whereas with banks want to know a lot about you. They want to see your business plan. They want to know about you. They want to know about your personal financial wherewithal, your personal balance sheet. They want to know about your business plan, your forecast. They want to look at all of these things. Credit cards don't ask for that. So that's really the difference, is information content. The nice thing about debt is that, as opposed to equity, where we said, for example, if I'm giving away 50% of my equity to get my $100,000, well, that equity holder has a say in my business because they own part of the company. The nice thing about debt is that the debt holder's interest in your company is limited to the interest that they get on the loan. And moreover, that interest rate is defined. So they don't have unlimited. It's not like they can just change the terms and increase it from 7% to 20%. It's a fixed return. And you get to repay that. And the only way that a debt holder gets more rights to you is if you default. And so it's in general, it's prudent for most startups, if possible, to use a mix, because you give up, if I share 50% of my ownership with someone else, if I sell the business or I want to pay myself a dividend, well, all shareholders have to be treated equally. So if I sell my business for $200,000, that $100,000 appreciation, I've got to share 50-50 with my partner. No such thing with the debt claim. The debt claim is limited to the terms of exchange that are set at the beginning. So let's talk about these other types of debt, and I really try to go from informally here from sort of more expensive to less expensive. Business credit cards, they'll typically have a minimum credit score, your credit score. And it's one important thing to establish at the outset here, but when we're talking about startups getting debt, is that you have to remember that when you start a business, yes, you've bought some equipment, and if that's appropriate, or inventory, or whatever it is to get started. You're leasing a space, you're doing, or buying a space potentially. But in terms of your business, it has no track record on its own. So your personal financial profile and that of your business are essentially the same day one. That's why they look at your personal credit score. They want to see how you have handled your obligations in the past. Having a lower credit score does not preclude you from accessing debt. It may be more expensive, but even in the lending world, the conventional banking world, I mean, everyone understands that there are certain events, unexpected events, that can occur in one's life. Oftentimes, divorces put us in a financial bind. Or maybe we made a bet on something, not literally a bet, but we invested in something that didn't turn out, or any number of things. We lost our jobs. You can have an event, a bankruptcy, that craters your credit score, but it doesn't mean that you don't have the potential to be a satisfactory payor in the future. And I see this every day with the SBA, and I'll get to that. But so if you have your credit score is not where you want it to be, continue to try to work on that to the best that you can, and understand that your past is not a predictor of your future. If you are, since you've had the event, whether it's a bankruptcy or a period of time, medical bills, that's a big one that throw people for a loop. When you're underinsured or don't have access to insurance, people will understand this. So you just explain it and move on when it comes to banks. And as long as it's a part of your past and not your present, it generally is satisfactory to provide an explanation. However, again, with these limited information providers like credit cards, your credit score will be important because, again, you and your business are the same when it starts. But again, it may be worth it to you to have that. There are online lenders. I mentioned a few names here. You can go on their site, and they are also relatively limited information consumers. And when it comes to offering you debt opportunities, they will be more expensive. The terms will be more restrictive than those from a payment standpoint than would be the case if you are getting a loan from a bank. Sometimes they might require weekly payments, even daily payments on what you take down or borrow from them. But again, we think about it as a means to an end. Depending on your circumstances, that can be the right thing. So it's worth it to check these sites out. There are lender marketplaces like Lendio, for example, where you go on, and again, you provide a fairly limited amount of information. They're not asking for your business plan. They'll look at your personal credit score and those of your partners, if you have any. They'll look at what you're going to use the money for. It's harder if you're a startup because a lot of times they want some kind of track record. In particular, they'll look at revenue and say, okay, what's your revenue been for the last 3 months? And if it's zero, it doesn't necessarily niche you, take you out of the game. It depends on the lender. But what's nice about Lendio is they have a stable of about 65 lenders that if you go on, you input this information, what business are you starting? How are you going to use the funds? Here's your credit score. There might be a few other things that they ask for, but it's not rigorous. And 65 lenders with 65 different appetites for risk will look at that, and they will come back with offers for you, or not. I mean, it's possible that you may not get any, but again, there's a lot of people that are willing to lend money at the right price. So I encourage you to take a look at these sites of the online and the online lenders who will provide loans to you directly, or Lendio, which kind of is kind of a broker, if you will. I think you might pay a nominal fee to be on their site and allow them to send your information out to all their lenders, but it's a fairly efficient process. Doesn't take long. That's also a benefit for it. You find out rather quickly whether it's going to work. We talked about crowdfunding. I don't want to go back into that again. Honeycomb, for instance, is based in Pittsburgh here. They've presented to our chapter of SCORE before. I'm actually working with a score client who is considering that right now. So, I think there are lots of different types of debt you can access. Other kinds that I want to mention, um, invoice financing, factoring, equipment leasing. What these have in common is maximizing your cash, maximizing your liquidity, because cash is never more king than it is when you are starting a business, when there is uncertainty about who is going to come through the door to buy your product. So, invoice financing, for example, say I'm a business, invoice financing is typically applicable more to business sales, because if it's a consumer, these days, it doesn't cost much to take a credit card or Venmo or any other type of payment source to realize your cash fairly quickly. But if you're selling business to business, in a lot of industries, say it's conventional for them to take 30 days to have 30-day terms, so-called, where they have 30 days to pay you. So you sell your product, they take 30 days, and so what are you going to do? You're starting up. You need cash. You need more cash because you want to keep going. You might have employees that you need to pay on a semi-weekly or a semi-monthly basis. So the invoice, what that allows, invoice financiers will come in and say, okay, I'll give you 100% of that within a couple days. Basically, just present the invoice, and they take a look at who the customer is. They might run some checks on that, and then they will charge you interest, but give you that full 30-day period or even longer sometimes to collect the amount. You are responsible for collecting it, and you will pay interest over time for the money that you got up front. And it isn't always cheap. I mean, 13 to 30%. It can really vary. But again, it's a means to an end. So compare that with factoring. Factoring will look at that same payment that's going to come in 30 days. Factors will say, I'm not going to lend against that invoice. I'm going to buy it from you. I'm going to buy that receivable that you have, but I'm going to discount it. I'm going to buy it at 70 or 80% of face value. What's the advantage to you? You get the money quickly. So again, 80% is well worth it if it allows you to basically get paid within 5 days of the inception of that sale rather than 30 days. And they take responsibility for collecting it thereafter. And the extent to which they discount that discount rate, whether it's 50% or 80%, is based on essentially the creditworthiness of your customer, not you. So they're going to take a discount because they're doing you a favor. They're getting you your cash quicker than you would otherwise. And the amount of that will just depend on the creditworthiness of your customer. Lastly, equipment leasing, or we work with clients all the time who are starting retail establishments. If it's real estate, unless you have a lot of cash up front, it's generally prudent, to rent versus buy right out of the gate. Because typically you're going to have a mortgage on that debt. So you've already got, a debt payment right out of the door before you even start that you're going to have to pay. Well, that's true for leasing too, but it's not going to implicitly, it's not going to have, it's a different kind of commitment. They're not going to have, a lease isn't going to be secured by the assets of your business. It's not going to necessarily be secured by your personal assets. It's just a lease for the space. And the lease versus buy, you have to put in a lot less cash up front. And the whole game is often, when you're getting a business started, keeping as much cash on hand as you can. Before we get into banks, there are various mission-oriented and community development-focused lenders that you can go to. These are often nonprofit institutions. There is one called ECDI in Cleveland. It's actually based in Columbus, but there's a Cleveland branch of this, and they are very interested. They have control of a loan that's backed by the SBA. that of up to, it can get up to $60,000 or $50,000 and up to 6 years to repay. If you submit an application, they'll work with you to try to get you however much you need up to that limit. They've been delegated that authority by the SBA. There are other institutions, HFLA, NEO. If you go to, they're in Beechwood. If you go to these folks, their only requirement, or one of their only requirements, is that you can demonstrate that you have been turned down in other places to get funding, and then their dollar amount is lower. At one point, they had mentioned that they were going to go up into $25,000, but I keep checking their website and I only see 10,000, which is not, I don't mean only, it's a large amount to me and you, but comparatively, it's less than, say, ECDI could provide. But again, means to an end, whatever you can get your hands on. Growth Capital is also a mission-oriented lender. It's what's called a certified development company. They actually work, they're part of their role in the development world, or the financing world, is, and with respect to real estate and equipment, they actually work, they are part of the 504 program. They're a piece of the process there in the 504 program that I work on. But again, they will work with you if you are buying real estate or buying equipment. They are someone that you could go to consider financing there. So again, we've got friends and family. Gotta mention them just because it is a way. So if your Uncle Jim is interested in your business, and is I often see in the 504 programs gifts from family members to help as part of the equity contribution that a startup investor or owner, an entrepreneur, is making to his business, his or her business, is a note or an investment from Uncle Jim. I would urge you to make those arrangements formal, not just sort of, okay, Jim, I owe you 50 or I owe you 30, whatever it is. Create a promissory note just the way it would be if you owed a debt like your mortgage or any other kind to a bank. You want to formalize the arrangement, and you want to specify the terms of repayment. Or if it's an equity position where there's not necessarily an exit prescribed, you want to be able to say, okay, I will make you whole within X number of years, because maybe Uncle Jim wants to be a part of your business in perpetuity. And that's kind of nice, because Uncle Jim, as opposed to a third-party source, might be comfortable with you running the business however you want to run it. I don't think that happens as often. I see this more as in debt. Make sure you formalize it, because the risk with friends and family financing is when it doesn't go well. And then, you don't want to risk those relationships souring because of a financial arrangement gone bad. And it does happen. And one of the ways you get around that is you have your promissory note. Make sure you give them your business plan. You treat them as if they are an outside investor. And they'll appreciate that. It will show your seriousness, as opposed to if I'm Uncle Jim and I'm coming back to Dan saying, come on, man, it's been a year and a half. I haven't seen anything on that 30 yet. You don't want to be in those situations. So let's talk about banks. Number one, banks with SBA support, and the SBA is not a direct lender. What it does through its guarantee programs is it guarantees a portion of the loan that a bank makes. That guarantee can be anywhere from 50% of the principal amount to 90%, depending upon the program. And what it does is it makes credit available where it wouldn't be otherwise. So that's how you get access to financing from a bank. And typically, banks are regulated institutions. And they are backed, those 100,000, deposit, guarantees that the FDIC provide. Those are essentially provided by me and you. That's taxpayer money. The banks pay it, but if a bank goes bad, they reach into funds that are taxpayer based. A bank is responsible to its community, and so they are more regulated in the types of loans that they can make. It is not a conventional thing for a bank to make a loan without any kind of guarantee support to a startup. The risk is simply too high. Unless, and this does happen, I've been a part of it before as a lender, unless someone with a fair amount of, with a good amount of money, frankly, relative to that which they need to get their business started. If I've got, let's go to my $100,000. If I've got, $75,000 portfolio of marketable securities, cash and marketable securities, say between my deposit account, and I want that $50,000 loan, and that's after I put in my $50,000 equity. Well, a bank will do that. I've done it with banks, knowing that cash puts some kind of constraints on the cash, so it can't just disappear all of a sudden. But that really only happens for startup entrepreneurs that have a lot of liquidity. For most of us, that's not the case. So then you need the SBA to step in. Here's kind of a brief description of their programs, and I've got links at the back of this presentation to a number of sources of information. But you can just Google, for example, I was actually not long before we got on tonight, just to refresh my memory about some of the particulars of some of the 7A programs. You can very easily see the types of programs they have. They are typically the terms, the length, and the interest rate or the range of the interest rates are usually known in advance. I mean, they'll state them. These are programs, established programs that don't change very often. So, but what makes you, allows you to get that access, where you say, okay, what the test is called, it's a no credit elsewhere test, which I already briefly described. It's that you can't get a loan as a startup on terms and conditions that are sort of conventional for the community in which you operate. If you go to 5 banks in Cleveland, they're going to say, I can't do it because you're a startup. It's too much risk for us, independent of some other kind of third-party backstop. That allows the SBA to come in. Now, the no credit elsewhere test exists for existing businesses too. So it's a threshold that has to be crossed for existing businesses, which comprise the bulk of borrowers that that SBA backed financing is geared to. You still have to demonstrate that you can't get it, and in those circumstances, it can be the type of business you're in, or the type of collateral that you would have. If I'm starting, I see this all the time, gymnastics facilities. Well, that collateral, it's not readily convertible to some other kind of use. That makes it so-called special purpose. Special purpose collateral is harder to exit. It's harder to turn over. It's harder to sell if a bank has to take possession of it. So that makes it harder for you to get credit elsewhere in the community without SBA backing. The SBA has programs that will step up and support those kinds of enterprises. So there are certain eligibility requirements which are fairly basic, and basically, as long as you have to be a for-profit enterprise, it has to be owned by U.S. citizens. It's very basic. For an existing business, there are some other eligibility requirements that need to be met as far as number of employees and revenue size. Like there are thresholds above which you are no longer considered a small business by the SBA. But as a startup, those aren't hurdles. And the other part is that for existing businesses is that you have to show that by the SBA providing its guarantee of this loan, that you're going to create a certain number of jobs or some other kind of economic benefit to the community. You don't have to demonstrate that. You're a job, and whoever else your partner is or your employees are, those are starting up from zero. So by definition, you meet that criteria. Let's talk about the process, and I'm going to talk, because these other types of financing, the less conventional types of financing, as I've explained, have fairly simple metrics by which they approve or deny. Let's talk about the bank process. And specifically kind of a bank approval process. You're going to gather your information, which again, listed here, your personal financials, tax returns, business plan, etc. and you're going to get that ready, and then they're going to identify lenders to approach, and a lot of people come to SCORT for advice on that. And if possible, you want to try to be able to meet with someone, because it's always better if someone who is decisioning your loan or has input on that process has met you. They just perceive things differently. And it's not always good. I mean, let's be honest. I mean, some people don't always make a great impression. Other people make a great impression. I mean, but it's still, on balance, you are far better to have a face behind the application than just be on a piece of paper. It's not always possible, but if you can, in general, where you're going to find that are the smaller banks. Huntington Bank, based in Columbus, but obviously huge Cleveland presence, Northeast Ohio presence. It is a top 10 SBA-backed lender nationally, very prominent. However, typically when you go to submit an application to get funds, SBA-backed funding, you're going to submit your application to a retail branch manager. Okay, they don't know anything about commercial lending. They have no say in what happens. They are just an avenue through which your application is routed. It used to be back in the day, and that's how I started, was on a retail bank floor as a commercial lender. Used to be when those were more thoroughly staffed. But for the bigger banks, the bang wasn't worth the buck when it came to small business. So they would prefer to just route that. And because frankly, for bigger banks, they're going to take all your information. They're going to take more than the other kinds of sources do. But if they lose on a $60,000 loan, that's not going to pinch Huntington. Okay, that's a risk that's acceptable to them if they don't know you personally. Basically, the more you're looking to borrow, the more interested a bank will be interested in meeting with you personally. That's not true. That's true for the larger banks. It's not true for the smaller banks, the savings and loans, the community banks. First Federal of Lakewood. I mean, there's any number of banks out there and credit unions. They will meet you, and you can often, maybe you won't meet the decision maker, but you will certainly understand the process, and you will know the person who is representing your interest in that meeting or whatever method they use to approve loan. So if you have those meetings, again, it gives you an opportunity to pitch your business. Just a couple of things that I always mention there. Ask them questions too. It should be a two-way flow. It shows that you're interested and that you're somewhat sophisticated when it comes to this process. Ask them what their approval process is, how they're organized, who would be working with them going forward, how would that all work, and importantly, timing for the turnaround of a decision. Don't sugarcoat your risks. I've seen business plans virtually say this is foolproof. No, it's not. It's just a fool that wrote that, because every business, whether it's Pepsi Cola or your startup, has risks, real risks. And so you want to acknowledge those. In fact, you want to tell them what your risks are beyond, about the particular kind of business that you're starting. You want to be out ahead of them if you can. And if they ask questions that you don't know, don't try to create an answer on the spot. Just say, I don't know. That's acceptable. Lenders don't have all the answers either. And just say, hey, I'll get back to you in 48 hours. So the process is really simple. And that's the point why I bring it up in these presentations, because there's a certain amount of fear, I think, when you approach a bank for the first time, like, ooh, Oz behind the curtain. It can look like that, but it's not. It's very simple. And there'll be a couple of folks that work on your loan, getting ready. Essentially, the bank will prepare a credit memo, which is kind of the same thing as your business plan, except it's geared to what the lender needs. And they may ask you some questions before they go back in. They'll look at your numbers, spread them so they can see ratios that they want to see. And so they get the memo together, and then we go to the process. Process is one of two things. It's either what's called a signature process or a committee process. Signature means when it's someone, the relationship manager or the account officer says, yeah, this goes to Dan. He approves all of our loans up to X amount. And so that's just what it is. That they submit the loan, they probably have a conversation about it, and boom, you get a decision. Other banks work on a committee process where a loan committee may meet, say, a couple times a week. And so if Jane is your lender or representing you, she'll say, okay, well, I think I can get this to committee by next Friday. And then you will have an answer. And if you don't get a call from Jane on that day, you need to be calling on Monday asking like, what's up? And make sure that you follow up on that. So, and then after that, if your loan is approved, I mean, they'll communicate that outcome to you. More importantly, if you're not approved, ask why. And none of us likes failure, but the thing about failure, and this is, sort of micro failure, but the failure, we learn much more from our failures than we do our successes. It's just the way it is. So you want to make that information useful. Take something from that outcome that is useful to you going forward. So in essence, I mean, again, after the approval, if you're getting a real estate loan, they're going to get an appraisal, these kinds of things. But in essence, there's no mystery. It's two people, really, credit analyst and the officer working on it. And then they either go to an individual or a committee and get your loan decision. How is it evaluated? So-called 5 C's of credit is kind of a rubric that's been around forever. But the 2 questions you want to answer when you're a startup, in your business plan, somehow, some way, and I've seen business plans that literally answer these questions as they are put here. Why does your business need to exist? What problem are you solving in the marketplace that the existing folks can't solve? How are you, in other words, how are you going to be different? And so if you answer your why, then you have to be able to say, why are you the person qualified to do this? What about your experience? And look, people transition from businesses all the time. I mean, they work for a business their whole life, Lubrizol or Eaton in Cleveland, Cleveland, for example. And then they want to start their own business. And it could be a bakery, something completely different. So on the face of it, yeah, that transition is a little more different because maybe you haven't run a business, a freestanding, independently standing business before, but you have skills, you have competencies, and you can demonstrate to a lender that I've done a lot of research on this, and that will show in your business plan. And depending on how complex, the more complex your business is, the harder that why you becomes. Because if it's a fairly simple business, self-storage, I mean, there's some complexity if you're building a self-storage lot with several garages on it where people can store stuff. There's not a lot to that. I mean, once you get started, I mean, there's more sophistication in terms of how they monitor and this, that, and the other kind, but it's not as complex as manufacturing a product. That is a complex process, certainly at the outset. And that is a more involved process. Suppliers, customers, equipment, making sure it's the right equipment, that everything goes through the process and it comes out with a quality product, you've tested for quality. That's going to be more complex. But at the end of the day, you need to be able to answer those questions. Often people append their resumes to business plans. I think it's a good idea, and include some narrative about why you think you can do this. So let's talk about the 5 C's. Character in one aspect, it's your credit score. Have you handled your obligations as agreed? And if not, can you explain why you were not able to? It also refers, like I was just referencing, to your experience. And when you meet with bankers, they get a clue for your character. When that's part, and you hope that's an advantage, right? That that's part of the experience, that they see your conviction, they see what you've done, they see your passion. And it also, banks can sometimes ask for references from other people that just to say, hey, as it would be as if you're submitting your resume to get a job. Same kind of thing. Capital, that refers to that equity that we talked about at the outset. And banks will look at that and say, okay, so they're going to have, based on how much equity or assets are contributed to this, then they'll have a certain amount of debt. And that allows them to determine what is called leverage, how leveraged your business is. But in general, people ask, okay, so if I have $100,000 of costs that I need to kick in general, and these are very general, but say 25 to 30%, it's kind of like a mortgage. 25 to 30% should be in equity. And depending on what your projected cash flows is, it can be maybe less or more, and how believable that projection is. And with the advantage of some of the SBA programs, like the one that I work in, you can provide up only 10% of the equity. And then it can adjust upward in 5% increments, depending upon whether, as I mentioned, it's a special purpose type of business or collateral, and whether it is a new business. So if you're a new business in my program, that extra 5% would have to be tacked on to the 10%. But in the scheme of things, that's still relatively small. And again, capital refers to how much you take out of the business, because again, as I mentioned, it reduces your equity. Capacity. How much cash flow do you have to repay or project to have to repay the loan? Obviously, you want that ratio to be greater than 1-to-1, because when you're just 1-to-1, and to overly simplify this, let's say your profit equates to your cash flow, and so I'm generating $1,000 of cash flow. Well, if I have to pay debt, principal and interest of $1,000 a month, it's good that I'm covering, but I got no wiggle room. And a lender's going to be more concerned about that, because there are not many businesses that work in the hockey stick fashion, where it just kind of goes whoop like this and just as a linear onward and upward. There's going to be changes. There's going to be things that happen. There's going to be things that you can't possibly anticipate. So lenders will want to be comfortable that your projected cash flow will be able to cover it by, say, at least 1.2 times the amount of debt that you have to repay in a given time period. And what makes those forecasts believable are the assumptions that you provided, and how much they are rooted in data, things that you've researched, prices that are in the market, costs that you know you're going to incur. And it's really the revenue piece of that is important, because you kind of know, for the most part, what your ongoing expenses are going to be right at the outset, based on how much you're going to pay someone, how much you pay lease, whatever it is. If you're renting equipment, you kind of know what those costs are. The revenue part is trickier. To the extent that you can break down unit volume, price per unit, even in a business that doesn't seem like it's meant for that, you're going to have some kind of assumptions with rigor to make your forecast credible. I mentioned a couple other metrics here. EBITDA, it's just a number that's used a lot as a proxy for cash flow by bankers. You don't need to worry about it now, but it's something that you might hear of in the future. Collateral, again, straightforward. They're going to take a lien on your assets, of your business assets, accounts receivable, inventory, equipment. You have real estate. They might not. It depends. Depends if the loan went to cover that real estate purchase. Then they certainly will. Can be intangible assets like patents, but lender's going to have a first priority lien on the assets of your business. And they're going to analyze your collateral to see how sufficient it would be if things don't go well and you can't pay anymore. What percentage of their principal can they get back by liquidating their collateral? And the higher that percentage is, or projects to be, the better off you are. Conditions. This can refer to the industry conditions in which you operate, how competitive it will be. So if you're doing a gas station, people do this, a gas station or a laundromat or a gymnasium, a gymnastic academy or an ice rink. I mean, these things do get financed, but you have to compare that to where the closest one is. And maybe the whole impetus for your doing it is, I got a lot of people that want to play hockey or just free skate, and there's not another rink for 50 miles. That's an advantage. Terms and conditions can also refer to the terms of your loan as well. So to conclude here, and I know I've gone through this almost by necessity kind of fast here, but you can look at this presentation, and if you have any questions about it, please reach out to us, and we can help fill in the blanks. But the recommended steps that I have for entrepreneurs, just kind of based on my experience, is when you're thinking about, if you have aspirations of getting out on your own, and lots of people do. I mean, there's been a boom in small business starts over the last 3 years, kind of out of the pandemic. A lot of people reevaluated their careers, reevaluated their lives and decided that, the 2 hour daily commute all in and whatever else it is, I'd rather be out on my own and working for myself, even though there's greater risk to me, at least at the start. But you can learn something from any business that you're in. I mean, first job I had when I was in high school was in the copy room, making copies of things. I was at an advertising agency. But not only did I sneak a look at the things that I was copying, I mean, people would just kind of come in and talk about things, and I would learn just by watching or talking with someone just a little bit more about how that business works, because I had no clue. And those kinds of things, there's more that you can get by osmosis than you realize. Again, the credit score, you can't get away from it. Build it, maintain it the best you can. We have webinars, information, articles on our website, by the way, which I should mention, which is also a resource to you if you want to start out by just looking for information on our website. We've got a lot about a lot of different types of businesses and about a lot of the different processes, marketing, financing, the things that are going to be inherently a part of what you do when you run a business. Grow your network, as you're getting ready to start and after, whether that's through work, volunteering, attending events. I've known people that want to start winemaking businesses or hard cider businesses, something in that realm where they will go around the state and they will attend events. They will, maybe they'll get a part-time job. If you want to start a restaurant and bar, I have seen the people that tend bar. I mean, you'd be amazed how much information you can get about running a place, a bar and restaurant, when you're working as a bartender or even a waiter. I mean, there's a lot you can get. Research your interests and business ideas. That's the one kind of wake-up call that a lot of people get when they come for assistance is, you have your idea. Yep, I believe it. It sounds like a good idea, but the third parties are going to want to see data-based conclusions and assumptions that are put out there. Research it. And there's lots of means. Tri-C. There's lots of information you can get through Tri-C or the Cleveland Public Library. They give webinars on, I don't know if it's a monthly basis, on how to use their resources through SCORE. I would take advantage of that. And then, obviously, but grow your knowledge base as much as you can. I mean, for your own sake. I mean, a lot of these things about research, they're for your own sake. They're not just for the lenders. I mean, you don't want to have the blinders on and kind of have what's called confirmation bias, where you interpret every kind of positive information about your business opening and saying, yeah, that's why I should do it. And you're not looking at some of the factors that may say, whoa, wait a minute, maybe I shouldn't. Because it's a whole different world if you haven't run a business before, and I haven't, not on my own, but I just know by having worked with people and even working with people who have existing businesses. Day one, you've got your loan. That's great. You're all set. Now you got to make it rain. It is a different kind of pressure. Now, many of us, if you own a home, you've experienced that kind of pressure. It's still a little different, though, because typically people get a mortgage, got your income, it's right-sized relative to your mortgage payment. So the risk is that you lose your job, but you have a lot of control in terms of how you do that and make sure you don't lose it. Here, you don't have a lot of control. You can market, social media, email, website, all of that stuff. They may not come even though you've built it. That risk exists. And so day one, you start feeling that. It's a different thing. And the way that you prepare for that is having thoroughly researched what you want to do. Talk to people that do it. And those are my recommendations. And I just want to conclude that way. And again, at SCORE, as I mentioned at the outset, we can help you in any which way. People that have been in all kinds of industries. And again, all kinds of functions, marketing. Bob Fedor here, who's on tonight, he's very well versed in nonprofits, for example. So if you want to do that, reach out to Bob. And we have there's kind of someone for everyone, as I mentioned at the outset, if this is what you want to do, if you want assistance. So thanks for your time. I know I'm running about 8 minutes late, but I just want to show you that I have a bunch of links back here some to the Cleveland Score sites. There are, crowdfunding, again, if you want to learn more about that, state of Ohio programs, SBA. You want to learn about grants. Everybody wants free money. That's why there's not a lot of it out there. And it's starting to dry up from all the pandemic authorized funding at both the federal and the state level, which tends to trickle down to the local levels. So grants are hard to get, but you can, they do periodically come out of the woodwork to assist, minority owned enterprises, or, they're often sort of mission oriented for the arts, or for, again, helping, underrepresented population, portions of people in the population in terms of accessibility to capital. A lot of the times they'll be geared towards that. And we try to make you aware of that when we learn of them. We're on our email list. So I suggest you sign up for the SCORE email, because it can't hurt. And there's a lot of times there's information about webinars and things that could be useful for you. NerdWallet, check out NerdWallet. When it comes to these other sources that I started out with those debt, credit cards, the lending sites, check out NerdWallet. They do a great apples to apples comparison of what is out there. It's a great site for kind of getting a summary and getting you started. And now, thank you for your attention, and I will cease speaking. If you have any questions, please feel free. Otherwise, thank you for coming, and have a great rest of your evening.
Okay, I don't see any questions, so I think we're done for the evening. So thank you. Thank you, Dan. This is wonderful. And I'm sure that it's been a great amount of information for the people who have attended. So you also have a pleasant evening. And I'm sure we'll be